We're wrapping up bank earnings on Wall Street, live from New York City this morning. Good morning, good morning. Equity futures positive, 0.5%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, Bank of America topping earnings estimates as Goldman looks a little bit lonely with the trading miss. It's the turn of the smaller banks after the close. We begin with the big issue, the regionals, up next.
We'll hear much more from some of those smaller mid-sized banks this week.
We're going to see those come out on Thursday.
With all this concern and caution around the regional banking issues,
I don't think we're completely out of the woods yet.
There's a big difference between what's happening with regional banks and what's going to happen with the major national banks.
The bad news is deposit flight.
Regional banks are more at risk than larger banks.
The regional banks will be critical.
They have higher funding costs. That deposits have become more flighty, and they're going to have to contract their loan books.
I'm going to be watching people like First Republic and Synovus and Comerica.
There's still signs of stress under the surface.
And that's going to be really interesting to watch.
We really need to probably should be focused mainly on the regional and smaller banks. We're just going to have to wait and see.
Let's get you the latest with Shonali Bassett. Morning, Shonali.
Morning, John. To your point here, Goldman Sachs is quite lonely in its fixed income business here. You have a flat revenue for fixed income trading over at JP Morgan. Citigroup, its third best quarter in fixed income trading in history. And then Bank of America having one of its best quarters in a decade. So what happened over at Goldman Sachs? There's pressure, remember, on the currencies, business, even the spread products you're seeing also under pressure at a lot of the big banks. It draws questions on just how much of a boost you can get from trading going into this environment. Now, remember, Goldman Sachs was trading above book value, Bank of America below book value. Now that trend is starting to reverse, and you're seeing Wall Street come back to the consumer business love. To add to that love, you have Bank of America on a call right now, really talking about some of the stabilization in certain businesses that are businesses like deposits, where you're seeing those deposit reductions starting to slow as the rate story becomes a little bit clearer. You also have here Bank of America talking about most of the pain in the held to maturity portfolios really starting to diminish in terms of the pain you're seeing as well. So hopefully that's a bellwether for the industry. But again, we have a host of regional banks ahead of us, starting with Western Alliance after market today. They are just one of a few. We have United Community Banks also reporting today, as well as First Horizon. Remember, it's not just the stocks, John. You have Western Alliance down more than 40% on the year. It's also the bonds. The bonds have sold off pretty dramatically here, and all of these bonds, as well as the CDS, have been massive trades on Wall Street. Now, after this earnings season, do you see some of these trades start to recover, as things are largely not as bad as expected, but there are idiosyncratic stories under the surface, and that is certainly where the trading activity is.
There are many, and we need to talk about them. Shonali, thank you. Goldman down by 3.4%. Bank of America up by more than 2%. As Shonali indicated, some of the regional players reporting after the close. We'll talk about them, led by Western Alliance. First Republic was due to report last Thursday. They'll report earnings next Monday. So put that in the diary, Monday morning, or rather Monday afternoon, perhaps, for that name. But the regionals over the next week, very much in focus for many reasons. Let's get to Morgan Stanley's Jim Caron. Krishna Mamani of Lafayette College joining us as well. Krishna, first to you. That word idiosyncratic, that word that Shonali just used, are we finding out this banking shock was truly more idiosyncratic than systemic?
I think the shock was systemic in that people had books of bonds and rates rose quite substantially. I think what is idiosyncratic is failure risk, which is if your deposit base was really skewed and your portfolio, on the other hand, was simply full of bonds, then you had a much significantly higher level of risk with respect to potential problems. I think what we will see in the future over the next few days is really the cyclical problem of having bank earnings remaining under pressure for quite some time until the Fed cuts rates.
I think this is a really important point, Krishna, and I think that is the question still, Jim. To what extent the tension of the last month is a substitute for rate hikes? To what extent do you expect there to be a significant tightening of lending standards across regional banks in America? What's the call on that now, Jim?
So the way that we look at this is that, look, clearly there is a tightening of credit conditions that's going on, but we also have to recognize that there's an easing of interest rate conditions that have gone on too. Rates have come down a lot. So there is a balance that we have to think about. And I think Krishna said it correctly. It's a cyclical issue at this point for what's happening with the banks. Now, in particular, the smaller banks, I should be very specific about that. The other issue that we have to think about, John, is what's the correlating agent here, right? This was an event. This was an important event that took place in March with the smaller banks. But did something also take place that created correlation risk, which created a sudden stop in the markets, that created a bigger problem, that had contagion? We didn't see that. And I don't think that we should look past that. And I think that's one of the reasons why we've been able to recover, that yes, there's going to be a credit crunch, not a credit crisis, but that credit crunch is going to take place over a long period of time. So it's not a sudden event, sudden shock event that creates a sudden stop in markets that creates that type of contagion effect that one would normally associate with a more systemic type of a problem.
Jim, to your point, it's the process. It's the beginning of a process that will play out over weeks, months, quarters, maybe even over the next year or so. With that in mind, Jim, can you make a call on how contained the macroeconomic spillover may well be from the shock of the last month?
Well, so far from what we're seeing, it seems reasonably well contained. I'm going to start with the dollar. So the dollar has been coming down. If you look at the Bloomberg dollar index, or if you look at other dollar indices, you're going to see that the dollar has been coming down in terms of weakness relative to other currencies. It's actually peaked somewhere around the beginning of the fourth quarter of 2022. We're not seeing necessarily spreads widen, CDS spreads widen substantially further than where they were before. Money markets, liquidity in the markets are still working well. So we're not really seeing the natural signs of a systemic shock. And typically you see that with a spike in the dollar value, because that's where a lot of long-term liabilities are placed, and people need to buy dollars to cover their risk. And we're not really seeing that. So I would say at this point that much of this has been pretty well contained.
Look at the pushback in the equity market from the south side at the moment. Here's 3 quotes for you. Let's start with this from Mike Wilson of Morgan Stanley. This is how we started the week. He said this: with the fastest Fed policy shift in 40 years, we think more negative surprises lie ahead for investors. One that we think is in plain sight is earnings forecasts that remain too optimistic. Emmanuel Julian over at Evercore says this: 23's pause is likely to see a further sell-off, recession, volatility spike before the inevitable new bull market gain. And then this from Marko Kolanovic over at JP Morgan: markets often bottom before the end of a recession, but not before the beginning of one. I want to pick up on that last line there, Krish Mamani. Markets bottom before the end of a recession, not before the beginning of one. There's some pushback as to whether October was truly the low. Krishna, you've come on this program repeatedly over the last several months and said the pain trade here is 4,500 on the S&P. Krishna, is that still the pain trade?
Indeed, and I think we are inching towards that. And one of the reasons is the views that you just articulated from everyone who is a prognosticator at the moment. The issue here is, yes, rates are higher. The risk of a recession is real, but the underlying momentum in the economy is still very, very solid. And I think if you look at housing, and if housing is not crashing at this level, I think it's difficult to say as to how it ends up being in a recession in the near term, and the expectations of the Fed cuts that are embedded in the market, how can they be sustained? So I think for now we are headed towards 4,500. We may be we are in a trading range, but the pain trade probably would be 4,500. The real question is, what is the outlook beyond that in the second half of the year? And I think the volatility in the market really would manifest itself, not because we arrive at a recession. It would manifest itself because the Fed rate cuts that are priced in the market get priced out, as we have done a couple of times in this cycle.
Well, let's talk about that. We've done that a couple of times this year already. I've gone through this a few times. January, it was soft landing and a bunch of rate cuts. February, it was no landing and a bunch of rate hikes. Then March, it was hard landing and the cuts are back on. I've got no idea what April brings. We're only halfway through the month. But Jim Karen, markets priced in a disinflationary shock off the back of this banking issue and a ton of rate cuts. We've seen some encouraging signs of stability in the financial system, and yet still we are pricing a disinflationary shock and a ton of rate cuts. Jim Karen, does that make sense?
So one of the things that you and I have spoken about in the past, and I've always said that risk off is, there's a risk on risk, and risk on is a risk. So the fact that a lot of people have become very, very defensive at this point, and there's a lot of money that's flown into money that's gone into money market accounts, does create some upside risk in prices, if you want to think of upside in prices as a risk. So I agree with what Krishna is saying. In terms of the rate hiking cycle, in terms of what makes sense and what doesn't make sense, what we have to understand is the market is pricing in lower interest rates by the Fed really as almost like a hedge, if you will. So in other words, if we're towards the end of the rate hiking cycle, where's the big move in rates likely to be? Well, it's probably likely to be lower because at some point, if the Fed hikes enough, the economy is going to slow and then they're going to have to cut rates. The Fed's going to be able to cut rates faster and by more than they're going to be able to hike. That creates a skew in the probability distribution of where the interest rates may go. So essentially what that does is it creates these lower short-term interest rates, which is what we're seeing in the bond markets today. But that doesn't mean that the Fed necessarily needs to cut rates. And in my view, I think that they can stay on hold for the rest of the year. And I think the markets are going to be probably mistaken about this. But yet the insurance premium for the market is for the Fed to have to cut rates. And you have to pay for that insurance by buying lower front-end yields. And that's what's priced into the markets. And it's very, very confusing to many people when we say, well, the market's saying this and the Fed's saying that. Yep. No, the Fed is saying that they want to keep inflation in check, and they may have to keep policy rates unchanged for the rest of the year in order to do that.
We're going to continue this conversation. Jim Karen, Krishna Mamani sticking with us. Just getting some Fed speak from Jim Bullard, the St. Louis Fed president, speaking to Reuters. Here's one headline for you. He favors more rate hikes, not one, which is implied by the dot plot in the latest SEP from the Federal Reserve, the summary of economic projections, but more rate hikes. We'll talk about that in just a moment. Equities stay positive, up 0.4% with some movers going into the opening bell. Here's Abby.
Hey, John. Well, let's take a quick review of the banks this morning. The tale of two cities or stories, bank stories here between Goldman Sachs and Bank of America. Goldman Sachs is down after they, of course, beat equities, missed fixed income. Their head count down and below estimates. Not as impressive a high bar expectation, so that stock down. Bank of America up 2.2%. They beat estimates on strength from fixed income. Bank of New York, to throw that one into the mix, they beat on deposits. Earnings was in line. Sales missed. The stock is lower. Taking a look at a couple other earnings movers. J&J, their first quarter sales beat from the consumer unit and COVID. They raised the outlook. The stock is up modestly. And then two industrials. We have Lockheed Martin higher, up 1.6%. They beat and reaffirmed the view. JB Hunt, on the other hand, down about 2%. They missed, and they are also saying that there are challenging demand trends.
Abby, thanks for that. Your broader equity market then again up 0.4% on the S&P 500, about 17 minutes away from the opening bell. Up next, China's economic growth picking up pace.
Look at that 4.5% GDP number, okay? Pre-COVID, we have never seen a GDP number as low as 4.5%. This is a better than expected number and a better than previous number, sure, but it's an awful number.
That conversation still ahead.
The classic reopening, we saw very strong services numbers already starting in February. Restaurant, hospitality, is that revenge spending that's coming through? Just to get to 5%, 5.5% even, it could be consumer spending, it could be a bit more infrastructure. And so 5% is achievable for this year. This year, 5%, it's actually a low bar to hit given the base effects and the consumer spending that's coming through.
China's economy gaining steam, an expansion of 4.5% in the first quarter, suggesting the country's recovery is well underway. The data triggering a wave of upgrades from JP Morgan, Citi, SocGen, now all looking for 6 handles on GDP growth in China in 2023. Citi economists expecting a boost to lower the need for any stimulus. Here's the line from the team. Quote, this year could be a window of opportunities for policymakers to address structural issues such as weak private confidence, youth unemployment and local government debt. For more, let's get to Bloomberg's Ender Curran down in Washington. Ender, talk to me. Better than expected. Is it good?
It's quite good. This is the consumer rebound everyone has been waiting for out of China. John, look at the figures, up 10.6% in retail sales, driven by catering and auto sales and double-digit gains there. So suggesting confidence across the board. But there are some weak spots. Investment, fixed asset investment was slower. Youth unemployment actually pushing back up to near record levels. And of course, the big question is, if you have a consumer-driven Chinese recovery, how will that spill over to the global economy, unlike, say, an investment-driven Chinese recovery would do? So there's some skepticism about what this recovery will mean for global growth. But you'd have to say, at the very least, these numbers were good. It suggests the government will hit their 5% target quite easily, and it does mean that the PBOC and the government probably don't need to tip in as much stimulus into the economy as might otherwise have been expected.
And what I've heard a lot of is this year good, better off the back of reopening, but then the challenges click in and next year gets harder, much harder. And maybe we need to start to consider 3 handles on GDP. How do you think about that one, Enda?
I think it's a fair comment, John. Let's not forget also the base effects. We're looking at figures compared to a year ago when the economy was in the funk with the Shanghai lockdown. So there is some of that. Next year, we'll be talking again about demographics, no doubt. All the big structural challenges. The property market still hasn't rebounded. There's plenty of headwinds in the pipeline for China's economy. And of course, let's not forget the whole geopolitics and decoupling debate as well.
And Karen, on the latest down in Washington on China's challenges over the long term, in the near term, that data is looking better than good. I want to return back to the Fed speak. Ton of Fed speak this week. Ends going into the weekend. That's the quiet period before the May Federal Reserve decision. I can't believe that one's come around so quickly. This from Jim Bullard, the St. Louis Fed president, speaking to Reuters. A couple of quotes for you. Bear with me as I read through these lines. Wall Street's very engaged in the idea that there's going to be a recession in 6 months or something, but that isn't really the way you would read an expansion like this. He goes on to say, the labour market just seems very, very strong, and the conventional wisdom is that if you have a strong labour market, that feeds into strong consumption, and that's a big chunk of the economy. It doesn't seem like the moment to be predicting that you have a recession in the second half of 2023. Jim Bullard of the St. Louis Fed favouring more rate hikes still ahead. Christian Mamani, I want to come to you on that. Back in March, we go to March 8th, and I think that's an important date for a lot of people who follow this market. It's the day before SVB started blowing up. It's the day after Chairman Powell really put a 50 basis point hike back on a table, or at least opened the door to one. And your 2-year yield was north of 5%. In the subsequent weeks, that 2-year yield dropped down to 350 something, 354, 355, something like that. Now, Christian, I just wonder, are you seeing enough so far just to reintroduce the idea that perhaps we have to go back to where we were pre-SVB?
Well, I think pre-SVB, we were expecting the terminal rate to be meaningfully higher. And I think that's what got the 2-year where it was. I don't think that is going to be the case. But I think what we have to deal with right now is not necessarily the terminal rate having a handle of 6 or 7. It's just that there are no rate cuts to be priced anytime soon until we see at least some level of unstickiness of the inflationary pressures or meaningful slowdown of the economy. And I think Bullard is right on that. That is, you're not really seeing any significant slowdown anywhere else other than in the bond market.
Jim Karen, where do you stand on that one?
So I'm in the camp that the Fed wants to keep rates as high as possible for as long as possible. And I think as high as possible is about 5.25% policy rates. So I think they're going to try to hit that target on May 3rd. They're going to get to that level. And I think they want to stay there until the end of the year, unless something pushes them to need to cut rates. And I think Jim Bullard is correct. The labor market remains strong. Look at core inflation. Core inflation remains sticky. If you look at the super core, all the inflation's going still in the wrong direction. We're not seeing the disinflation that the Fed is hoping for. So to me, the biggest worry for the Fed, what keeps them up at night, is that inflation becomes unanchored. Yes, it's coming down, but what if it doesn't come down enough? And what if the year-over-year base effects in 2024 start to push it back up? And if that happens, then the Fed may have to re-enter the markets and start hiking again from a higher level. They don't want to do that. That would be very devastating for asset prices. So I think if they have a choice to cut rates in the second half of this year or keep them on hold for longer, I think they're going to do that. So I think there is a mispricing in the bond market with that respect.
I just want to pick up on that range of outcomes, those range of outcomes, Krishna, and give you a decision to make ultimately. Just your base case right now. Each and every outcome is going to have a different probability, obviously. Mohammed Al-Arian wrote in the last week or so, and he offered these 3 ranges, and I think they're important to look at. One is that the Fed pauses in May, does what it's implying it will do in the dot plot, and stops right there. That's your terminal rate, just north of 5%. Now, you can pause and then start cutting, or you can pause and then hold through to year end, or you can pause and start hiking again. Krishna, of the three right now, what's your base case?
Pause. That is, they probably get to somewhere 5.25, 5.5, maybe if June comes back into play because of some data point, but then stay there for the rest of the year and probably even in early 2024 would be my best guess.
Is that a world in which equities do well?
No, so I think that's the point I was trying to make earlier, which is equities, given where we are and lack of volatility, may get to 4,500. But it's when we start repricing the bond market and the expectation of Fed cuts, that's when equities probably go down, not because of recession. It's just that there is no recession.
And that's the tension for the back half of this year. And Jim, I think that's what you're saying as well when you talk about the hard data being on a collision course with what's developing. Is that right, Jim?
Yeah, that's exactly right. So essentially, the hard data right now is going to slow. We are going to see some slowdown. But the reality is that if we look at equities, the earnings trough is supposed to be in the first quarter and the second quarter of this year. After that, in the second half of this year, we're going to start to see some marginal improvement. Earnings forecasts are negative for 2023, but then they rebound in 2024. So the issue for the equity markets is, do you look through this air pocket right now in the earnings year-over-year cycle? And I think the equity markets are saying that we do, unless we see a hard landing. So if we don't get that hard landing, don't get that recession, the path of least resistance may be to percolate to higher equity prices today.
Hey, Jim, wonderful to get your view. Jim Caron there, Krishna Mamani, to the two of you, thank you. Coming up on this programme, the morning calls and later, big bank earnings continue to roll in. We'll lift the lid on those numbers with Stephen Bigger of Argus, plus the earnings outlook from Alpine's Sarah Hunt. That conversation up shortly. About 4 or 5 minutes away from the opening bell, equity futures positive here by 0.4% on the S&P. That's the price action. Let's get you some morning calls. Citi upgrading Chubb to buy, 229 price target, seeing multiple paths for growth and a strengthening balance sheet. KeyBank downgrading First Solar to sector weight, expecting limited upside following the stock's recent outperformance. We're down there by about 1%. And finally, Atlantic Equities upgrading Comcast to overweight, saying the stock is well positioned for a recession. Coming up, Bank of America looking good. Goldman, not so much. That conversation up next with Argus's Stephen Bigger and Alpine's Sarah Hunt. Equities looking okay here, about 20 seconds away from the opening bow this morning. Good morning to you. Futures positive 0.4% on the S&P. Breaking back up. The Nasdaq 100 up by about 0.7% there. 4,200, the line in the sand on the S&P 500. For a number of months now, we've all got one eye on that around the open. There's your opening bell. Switch on the board and get to the bond market. Yields look a little something like this, unchanged on a 10-year, 359.47. Yields unchanged. Euro dollar just about unchanged as well. No drama here. Positive 0.2% at 109.50. And crude going absolutely nowhere. $80 and about 85 cents. 15 seconds into the open, the S&P 500 positive 0.4%. The broader Nasdaq up by about 0.6%. Two stocks to watch at the opening bell. Bank of America and Goldman. Two banks, two very different realities. B of A delivering a profit. B as Goldman misses out on the fixed income boom. Abby has more. Hey, Abby.
Hey, John. And yeah, that fixed income situation, that seems to be the real difference between Goldman Sachs and not just Bank of America, but the other big banks as well. So Goldman Sachs, of course, the stock is down today. Bank of America is higher as Goldman Sachs's fixed income misses the mark and down about 17% on a year-over-year basis, whereas Bank of America really blows it out of the water. Let's take a closer look at Goldman Sachs, though, a broader look, because their equity business actually beat. And so overall earnings were a beat as well. Sales were a bit of a miss. What we do have, though, is a higher bar proving challenging because this company has really outperformed over the last year. And one point around this, it It is basically flat over the last year, the stock, whereas Bank of America is down about 20% over the last year. They also did show that headcount reduction, probably a little bit more aggressive than what people had been expecting. Bringing Bank of America into the story, they really beat right across the board. Sales, earnings, FICC trading, that FICC trading beating by 31%. Net interest income for Goldman Sachs, on the other hand, missing by 19%. If we take a closer look at the FICC miss, because that really seems to be what's weighing. Last year, for their first quarter, they put up $4.7 billion in FICC trading. This year, $3.9 billion, again, a 17% decline thereabouts. So the stock is down. But again, remember, Bank of America underperforming over the last year, Goldman Sachs outperforming, so a little bit of an evening here.
Also worth pointing out as well, that move on Bank of America might not look like much, up by about 0.8%, but over the last couple of days, decent rally put together on Friday after the JP Morgan numbers, up by a little more than 3%. Yesterday, up by close to 3% as well. This morning, of course, up by 6 or 0.7%. Goldman lower by 3.5%. Abby, thanks for that. Working through some of the big names this morning. Morgan Stanley, the final big name to report tomorrow morning. Looking forward to that before the opening bell. I want to turn to the smaller banks just briefly. BNY Mellon's first quarter deposits topped analyst estimates. The company's CEO said this: time and time again, BNY Mellon has been a port in the storm for our clients in times of market turmoil. Shonali Bassett wraps it all up for us. Hey, Shonali.
John, it's amazing how many banks we're looking at this season. You have Bank of New York Mellon really showing you a different story from State Street, but we have a host of regional banks ahead. If you take a look, there are very big differences in what is expected from deposit outflows. But I've got to say, if you look at the banks that have reported so far, it's not just a deposit story. It's a profitability story and the ability of these banks to lend. Just take a look at what happened at M&T yesterday. For example, the deposits missed slightly on estimates, but their net interest income was able to meet or beat expectations, even with some provisions for loan losses. So really, the health of these banks is a real question. If you take a look at those estimates on deposits, a lot of these differentials are regional. Western Alliance are expected to report after the market today, Phoenix-based Western Alliance, then First Republic, and we've talked about this a lot. We're not out of the clear for this system here until we hear from First Republic early next week. And so you see U.S. Bancorp, PNC Financials, the larger of the regionals, really holding steady on the deposit picture, really comes into line with what Bank of America is saying here, that pressure on deposits, it's still there, but it's starting to ease a little bit. Now, the big question in the market is how sticky are deposits overall. JP Morgan says not very sticky. Bank of America is saying pretty sticky. So does the consumer story give some love to these banks that have been so poorly beaten in the stock market up to this point this year?
Shonali, thank you. The regional banking story there, just a bit softer by 5 or 0.6%. Shonali will, of course, drop by tomorrow morning to work through some of those regional bank earnings we get this afternoon, and Morgan Stanley coming up before the opening bell tomorrow too. Back with us now, I'm pleased to say, Stephen Bigger of Argus Research joins us to talk about some of these names. Stephen, great to catch up with you, sir, as always. I was going through some of your calls before the programme. Bank of America, buy. JP Morgan, buy. Morgan Stanley, Citi, Wells, buy. Do you like what you've been hearing over the last week or so, Stephen?
Well, yeah, so far so good. I think, there's been a 100% beat rate. If you, take out some of the asset custody banks like State Street yesterday. And yeah, these have been, pretty good results. I mean, I think we've, banks have demonstrated the power of diversification, basically, in the large banks that you mentioned. Some of the smaller regional, even mid-sized regional, I think are going to have a tougher time coming up with earnings yet to report. This deposit conundrum that banks are facing right now with some outflows is going to be watched pretty closely here. But yeah, the large banks, I think the trading's still doing well. Investment banking has been weak as expected. Net interest income probably the peak for the year this quarter though. Facing some deposit, some margin pressures as the year goes by.
One name underperforming this morning, it is Goldman Sachs. Now, Stephen, that's one name I didn't mention next to the word buy. From you, you say hold. Where did they fall short for you, and was that validated by what you saw in the numbers this morning?
Well, yes, it does. I think our whole recommendation is that Goldman is still, as old as the bank is, I hesitate to say, still trying to figure themselves out. They're, an investment bank and trying to tack on a consumer bank on top of it, and they're thirsty for those low-cost deposits, or which had been low-cost deposits, up until 6 months ago. So, this is a bank that is Goldman is very reliant on trading and investment banking. In fact, what I would say that every quarter they wake up and they have to earn probably 60% of their revenues in terms of trading and investment banking, whereas your larger global peers wake up with probably 80% of the revenues kind of already in the bag in terms of net interest income and other transaction banking. So it's a work in progress with Goldman. The sheer volatility, I'm afraid, results in a perennially lower PE and other valuation multiples, and I think that's the thing that they have to overcome. Just get more consistent on those return on equity targets in order to be more comfortable with the buy recommendation.
Should say about 7 minutes into the session, Goldman still underperforming, down by about 3.5%. If you look at Bank of America, it was positive by 6 or 0.7%, just turning negative by almost 1% just moments ago. Stephen, I just wonder, you don't just cover the big names, you cover some of the smaller names as well. When we get to the end of the quarter and you've heard from all the names in your coverage, what's the headline you expect to write? That the big banks crushed it or the smaller banks got crushed?
So I think it's the big banks crushed it. There has been a flight to safety in the industry here. Deposit flows still favoring the large banks. And, the industry itself has to really figure out this deposit situation. They either want to chase those deposits and pay up for higher rates or not. And I think to date they've not. And the reason is that deposits are still above where they were pre-pandemic. The industry had a flood of deposits during the pandemic, and I think they have room to wear those deposits off a little bit before they start to worry about having to either up rates to attract more deposits or to have to borrow funds, which they also can do in the open market. But yeah, the big banks I think are the place to be. As well as I would add, though, the super regionals, the Truist Financial, PNC, USB. These are all banks very well positioned, great, national or near national franchises, great deposit bases, and again, very good diversification in their business models. Small regional banks, if your only bread and butter is really lending, and you've got a fair amount of commercial real estate mixed in there, I think you're in for a much tougher year.
It's going to be a tough time. Maybe we see that in the numbers a little bit later on this afternoon. Stephen, thanks for that. As always, Stephen Bigger there on a busy morning for him, with some of the big banks reporting this morning, and then a little bit later on this afternoon, the regionals really kicking things off with Western Alliance. Schnally's talked about that a few times. Your broader equity market about 9 minutes into the session, positive 1/3% on the Nasdaq, up almost 1/2%. Sarah Hunt of Alpine looking for signs of an earnings slowdown. She writes this: recent estimates do not seem to be showing an anticipated slowdown usually associated with a recession. Do they need to come down further? That is the biggest question of this earnings season that has just begun with very good numbers from big banks. Sarah joins us right now. Now, Sarah, I guess it ultimately comes down to whether you think there will be a recession or not. Now, where'd you come down on that?
I think it's really hard to tell. I think we're still all working through data. I think you just saw some slowdown in housing data. I don't disagree that even though we've been arguing about when these long and variable lags come in, that they are actually coming. I look forward to seeing the senior loan officer survey in May. But I have to say that it's hard to believe that credit doesn't contract or that people don't make as much investment when you have to pay 5 or 6% than when you were paying 1 or 2% or 3%. So I just don't see we've really worked through that yet. And I think that the market seems to be anticipating cuts by the Fed before we're even done with this tightening cycle. And I think that the Fed will probably stay higher longer as long as there isn't underlying problems in the economy because of the higher rates.
What do you make of these comments from the St. Louis Fed president to Reuters in the last 20 minutes or so? The labour market just seems very, very strong. The conventional wisdom is that if you have a strong labour market, that feeds into strong consumption, and that's a big chunk of the economy. It doesn't seem like at the moment we should be predicting that you have a recession in the second half of 2023. Is that something that resonates with you, Sarah, something you'd push back on?
Well, I think, this has been the biggest anticipated recession in quite some time. So people have been looking for this. And I don't disagree that the labor market has held up very well, but it's hard to figure out if it's held up really well because of the previous payments that people received during the pandemic and or the fact that people had to rush to staff to get things together. And wages don't seem to be accelerating as much as people had originally anticipated that they would. And you still have a lot of people out of the labor market. So the question is exactly how tight that is and whether or not wages are actually going to go up. I think you've got a lot of questions about where margins are going to go, and that's a little bit about labor pricing. I don't know when this happens, but clearly like the extension on timing has come through here because we were earlier last year, people were anticipating a slowdown in the first half. We always thought it would be the second half, and now it's hard to figure out whether or not that's being pushed out even further. But I think it is coming, and I think that that's where the equity markets are sort of anticipating that we've already gotten through that.
Is the juice worth the squeeze? Marko Kolanovic over at JP Morgan says it's not. He says the following: even a mild recession would warrant retesting the previous lows and result in over 15% downside. He went on to say, we view this rally as irrational. We continue to believe a recession is likely this year. If I asked you that, Sarah, then ultimately, is the juice worth the squeeze? Is the upside worth chasing given the downside that could materialize?
I think from where we are now, I have to agree with him. I think it's very difficult to go chasing it now. I think that that's, we came into this year, people were very much positioned for a slowdown. That didn't happen, and you got very good earnings and you got very good numbers and some good economic statistics. And now the question is, from here, what makes the market go higher? I think the anticipation has been, well, the Fed cuts rates and demand gets higher. I think, good news out of China this morning, that was helpful for markets because growth somewhere else is still growth globally. But I do wonder where we are now versus where we should or could be in the next few months, given what may come through on some slower earnings and some, I think, slower economic statistics. I think, look at the housing numbers this morning. I think that's not a trend yet because that's just 1 month. The fact that you're seeing the slowdown, I think that that's finally coming through because of higher interest rates.
Where does that leave the energy trade, Sarah, that I know you love?
Well, I still do like the energy trade. It's been very challenging, although the recent uptick in oil prices on the back of the Saudis cutting isn't necessarily something that you want to see those prices go up because of cutting. You want to see better demand. I'm not sure that the China numbers are good enough to help demand right now. I think globally, if we have a slowdown, that's tough on energy demand. But at the same time, you have a supply problem because you haven't done enough investing. So I still think that there is good value in the energy trade. I think you can clip some nice dividend coupons from some of your big integrateds. We happen to like Chevron of those, but I think that there are also some plays in natural gas. I've mentioned Chart Industries before. They had some good numbers and put up a nice backlog. I think there's some nice places in that space to play because this transition that everyone's talking about and the expense that that is going to cost is going to mean that there are beneficiaries of that. And to the extent that some inflation is self-inflicted because we want to transition away from hydrocarbons, that's also part of the larger story that I think is difficult to figure out exactly how that plays into all the other inflationary numbers.
Sarah, when some of those majors report, let's catch up again later on this earnings season. Sarah Hunt, the brilliant Sarah Hunt of Alpine, Sachs and Woods. The underlying commodity, crude right now, still just about holding on to the 80s, $80 and about 50 cents on WTI, softer by about 0.5% on the session. If you're looking at Brent, 84.36, we're negative about 0.5% there. Just want to check in on the bank earnings for you, or rather the price action off the back of the bank earnings. Bank of America just about unchanged on BofA. BofA just about unchanged to down 0.1% after opening up positively a little bit earlier this morning. Goldman still trading lower by 2.65%. The broader market up by 1/3%. Coming up on this program, Apple teaming up with Goldman to debut a high-yield savings account.
Goldman Sachs, I think, is desperate to attract deposits there. Apple is basically only a brand name on top of it. Let's be frank about that. It's really Goldman Sachs doing all the work in the background.
That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, an interview with actor and investor Ryan Reynolds. That's at 1:30 p.m. Eastern, 6:30 p.m. in London. This is Bloomberg.
4% on a savings account is quite a hefty amount of interest compared to what many of the other large banks are offering. So Goldman Sachs, I think, is desperate to attract deposits there. Apple is basically only a brand name on top of it. Let's be frank about that. It's really Goldman Sachs doing all the work in the background and sort of putting the Apple logo on the top of it. So Apple's involvement there is really branding only.
Apple and Goldman joining the race to lure depositors, teaming up to launch a savings account with an annual yield of 4.15%. This is Apple opens its first store in India. The CEO, Tim Cook, saying during the company's latest earnings call, India is a hugely exciting market for us and a major focus. I'm very bullish on India. Ed Ludlow joins us now on the West Coast. Ed, two stories there. Let's start with the first one. This Goldman Apple combination. What's the push all about?
The push is all about bringing users who are not hardware users into the ecosystem through the attraction of services, right? It was interesting, the comments of that soundbite. You have to be an Apple Card user. You have to be in the United States. The Apple Card is created by Apple, but it is issued by Goldman Sachs. You know, Apple notes in their statement that 4.15% yield is 10 times the national average. I think I was talking with some colleagues about this morning. Surely in the near term, this isn't a moneymaker for Apple, but think about all those people around the world that do not have an iPhone or do not use a MacBook. The attraction of a 4.15% deposits account in this week of all weeks, John, when we're looking at deposit data from the biggest and the smallest banks, longer term, the play for Apple is to really pump that services side of its business. And think about the data that they can get access to in offering something like that, particularly those customers that they don't have data on from the hardware.
How does it complement the broader push then, I think, is the broader question, ultimately then, Ed, and the stickiness of the ecosystem that Apple is offering? Is this just a supplement, a way of complementing that effort?
Yeah, I don't know what you get on your savings account, John, but I get, what, 0.01% currently?
Something so I think close to zero.
Yeah, so I think 4.15% turns a few heads. You know, think about that, the attractiveness of that offer. I guess my point is, you know, you can bring in new customers who are not iPhone users, who are not MacBook users. They get exposure to the banking or financial services from Apple. That introduces them to other services from Apple, which may lead to them becoming hardware customers as well. This isn't a huge surprise. Remember, they announced the initiative back in October. They're just putting flesh on the bones of that strategy. But 4.15%, as your guest said, is also a Goldman story, because Apple is not a bank, it's just the brand.
And as someone pointed out, Apple's just the wrapper for the Goldman product, but the tension comes with the very fact that you can get more on your Apple yield than you can from Goldman in Marcus, even though Goldman is back in the Apple effort. Makes sense of that. Ed, thank you, buddy, as always. Ed Ludlow there on the West Coast on the latest with Apple. Two big pushes there, the financial side of things and in India. Big push in India we'll talk about in the months to come. I want to talk about Netflix. They report after the closing bell. Guggenheim expecting new subscribers to top estimates. The analyst writing this. A positive outlook is driven by the anticipated impact from recent international price cuts in certain markets and slower than previously anticipated rollout of password sharing. Geetha Raghunathan joins us now, Bloomberg Intelligence. Geetha, to you, what do you expect a little bit later on this afternoon?
Yeah, absolutely, John. So it's been 1 year since the great Netflix meltdown and the correction. I think overall the sentiment is so much better, but it's probably going to be a little bit of a mixed bag as we head into this quarter. So Netflix has actually stopped issuing subscriber guidance, but the street is looking for about 2.4 million subscriber adds for 1Q. We think it actually comes in slightly better than that. But again, remember, this quarter is a little bit tricky. You have too many different things going on. As you just mentioned, there's the new advertising tier that was launched. We have this password crackdown efforts that they're kind of implementing market by market. And then they did implement price cuts in about 100 emerging markets. So you have all of those different balls in the air. We're expecting positive commentary on all of that. I think where the market and where investors might be slightly disappointed is if Netflix kind of walks back. So what they had said initially was that in 2Q, they were expecting this major inflection in subscriber trends. But if they walk that back on the back of, you know, password sharing, just because there's a lot of volatility when you kind of implement password sharing, I think that's where, you know, investors could potentially be a little bit disappointed.
I have to say I'm pleased they no longer offer guidance around subs because they were terrible. Are offering guidance around subs, which were way out of whack with the actual numbers. Geetha, thank you. As always, we'll touch base with you tomorrow morning after we get the earnings a little bit later on this afternoon. Look out for the coverage from Ed Ludlow and Caroline Hyde at about midday Eastern time. A couple of hours from now, they'll pick up on that story. Abby, let's look at the price action together. Just briefly, the sector price action. Over to you.
Well, we do have the S&P 500 slightly higher. The best sector is technology, up 1%. The worst, healthcare, being weighed on by Johnson & Johnson, down 0.4%. Most interesting interesting, John, is the fact that we have volumes above average for both the S&P 500 and the NASDAQ. It has to do with that tech strength and the chips. Chips outperforming on the day, John.
Abby, thank you. The equity market up 1/3%. Your trading diary up next. "26 minutes into the session, just about positive on the S&P by 1/3%. Let's get straight to the trading diary. Coming up shortly, Fed Governor Michelle Bowman, 1 p.m. Eastern Time. Netflix earnings after the close and results from some of the regional names, First Horizon and Western Alliance, just two of them. On Wednesday, Morgan Stanley reports earnings, plus we get the Fed's Beige Book, another round of jobless claims on Thursday, and more Fed speak. Waller, Mester, Bowman, Bostic and Harker. And we round out the week with the US PMIs on Friday. That rounds out the morning for me. Good morning to you all. This was the countdown to the open. This is Bloomberg.